Most people know they should be investing, but when they actually sit down to do it, they freeze. What do I buy first? How much? In what order? The good news is that building a dividend portfolio from scratch is not complicated if you follow a clear system. In this video, I'm going to give you that system, step by step, from zero to a portfolio that pays you every single month. Whether you're starting with $100 or $10,000, this framework works. Let's build it. Before we get into the steps, let's establish what we're actually building here. A dividend portfolio is a collection of investments, stocks, ETFs, or REITs that pay you regular cash distributions just for holding them. The goal is to build that stream of payments large enough that it covers a meaningful portion of your expenses. In 2026, with high-yield savings accounts still offering decent rates and the stock market at elevated valuations, dividend investing has become more strategic than ever. You can't just buy anything that pays a dividend. You need to buy the right things in the right order. Here's the step-by-step process. Step 1. Choose your brokerage. Before you buy a single share, you need an account to buy it in. In 2026, the best options for dividend investors are all commission-free, meaning you pay nothing to buy or sell. The top three to consider: Fidelity, Charles Schwab, and M1 Finance. Fidelity and Schwab are the most established. Both offer fractional shares, automatic dividend reinvestment, and excellent research tools. M1 Finance is built specifically for portfolio-based investing. You set up a pie of investments and it auto-rebalances for you, which is perfect for a dividend portfolio you want to run on autopilot. For most beginners, Fidelity is the best starting point. Open an account, fund it with whatever you're starting with, even $100, and you're ready for step 2. One important note: open a taxable brokerage account if you want flexibility, or a Roth IRA if you're investing for retirement and want your dividends to grow tax-free. For most people under 50, a Roth IRA is the smarter choice. Step 2. Set your core allocation. The most common mistake new dividend investors make is buying random high-yield stocks without a plan. The result is a chaotic portfolio that's hard to manage and exposes you to unnecessary risk. Instead, think in 3 layers. Layer 1, core, 60% of your portfolio. Broad dividend ETFs with low fees and proven track records. This is your SCHD, your VYM, diversified, stable, growing. These are the holdings you never touch. Layer 2, income boost, 30% of your portfolio. Higher yield ETFs like JEPI or DIVO that generate more cash right now. These are your monthly income engines. Layer 3, high yield, 10% of your portfolio. A small allocation to higher risk, higher reward positions. Things like QYLD or individual REITs. This is your accelerator layer, kept small to limit downside. A simple starting allocation that works: 60% SCHD, 30% JEPI, 10% QYLD. 3 tickers, fully diversified, balanced between growth and income. Step 3. Start small and automate. Here's what separates investors who actually build wealth from those who don't. Automation. Set up a recurring transfer from your bank account to your brokerage, weekly or monthly, whatever fits your budget. Even $50 a week is $2,600 a year, plus compounding, plus dividend reinvestment. The amount matters less than the consistency. Every major brokerage lets you set up automatic investing. You tell it how much to invest and in what ETFs, and it executes on a schedule without you doing anything. Enable DRIP, Dividend Reinvestment Plan, on all your holdings. This automatically takes every dividend payment you receive and uses it to buy more shares. In the early years, DRIP is one of the most powerful tools in your arsenal. A $50 dividend that buys more shares generates its own dividends next quarter. That's compounding in action. Set it up once, automate it, and stop watching it every day. The worst thing you can do to a dividend portfolio is tinker with it constantly. Step 4. Track your progress with one metric, 545 to 7. Most investors track portfolio value, the total dollar amount of their holdings. That's the wrong metric for a dividend portfolio. The number you should track is monthly dividend income. This is the actual cash your portfolio is generating every 30 days. It's tangible, it grows predictably, and it keeps you focused on income rather than price fluctuations. In a spreadsheet or a free app like Dividend Tracker or Snowball Analytics, log your holdings and it automatically calculates your projected monthly income. Watch that number grow month over month. When the market drops and your portfolio value falls, your monthly income often stays flat or even grows because dividend payments are mostly independent of short-term price movements. A portfolio that generates $50 per month today will generate $100 per month in a few years, not because you added more money, but because the dividends grew and you reinvested them. That's the metric to obsess over. Step 5. Expand strategically as you grow. Once your core 3 ETF portfolio is established and running on autopilot, you can consider expanding into individual dividend stocks, but only when you have enough capital that a single stock's dividend cut won't meaningfully hurt your income. The best sectors for dividend stocks in 2026: healthcare, Johnson & Johnson AbbVie; consumer staples, Procter & Gamble, PepsiCo; and energy, Chevron, Enterprise Products Partners. These sectors have paid and grown dividends consistently through recessions, pandemics, and rate cycles. A good rule of thumb: no single stock should represent more than 5% of your total portfolio. This keeps any one company's bad news from doing real damage. Also consider adding REITs, real estate investment trusts. As you grow, REITs are required by law to pay out 90% of their taxable income as dividends, which makes them some of the highest yielding investments available. Realty Income, ticker O, has paid a monthly dividend for over 25 years and raised it more than 120 times. Let's bring it all together. Building a dividend portfolio from scratch comes down to 5 steps. Choose a brokerage, Fidelity, Schwab, or M1 Finance. Set your core allocation: 60% core ETFs, 30% income boost, 10% high yield. Automate everything, recurring contributions, and drip turned on. Track monthly income, not portfolio value. Expand into individual stocks and REITs as your portfolio grows. You don't need to be wealthy to start. You need to start to become wealthy. If this helped you understand how to actually build a portfolio, not just what to buy, but how to structure it, subscribe. Every week, we cover practical strategies for building passive income and investing smarter using AI. Next week, I let ChatGPT pick my stocks, and then I compared its picks to the market. The results were surprising. You don't want to miss that one. Subscribe, and I'll see you next week.